All right, guys, so today we're talking about building wealth. And as a financial coach, I would say this is my favorite topic to talk about. A lot of people want to be wealthy, they want to be out of debt, but they're not really sure what the first step is or how to get the ball rolling. And so that's where I come into play. And today we're going to talk about some basic steps that you can implement at home and start building that nest egg so that one day you can retire with money. So when we talk about building a financial house, we're going to build it the same way that we would build a normal house. And when we build a normal house, the first thing we're going to do is lay down the foundation. And in that foundation, we're going to put insurance. The reason why we put insurance in that foundation is because insurance protects us in case anything goes wrong. And this is what helps us sleep well at night. So the first type of insurance that we're going to talk about a little bit is health insurance. Now, most people have health insurance through their job or private insurance or through Medicaid. Okay, but we can't overly stress how important it is to have health insurance. We have to be healthy so that we can go to work and make money and put that money into an account somewhere so we can eventually become wealthy, right? The next kind of insurance is homeowner. And for those of you who don't own a home, renter. Now, these insurances are very, very important because we want to protect our house, right? If it is broken into, it burns down, floods, a hurricane, anything that may happen to our house, we want to protect that asset. And if we don't own a house and you live in an apartment, then you want to have renter's insurance. The reason why you want to have renter's insurance is because that protects all of your personal belongings. You see, the landlord typically has a policy that covers just the dwelling. It does not cover anything inside of it. So you as the tenant have to have your own policy that protects all of your personal possessions in case something happens to that apartment. Then auto insurance. Everybody's familiar with auto insurance, right? It's government mandated. But what a lot of people don't know about auto insurance is that if you have your deductibles and your limits set too low and something happens, the person, you get into a car accident, the person that you hit or the person that hits you and they get damaged or they get hurt, they can come after you in court. Well, if they sue you and your limits are set too low, then that means that they can come after other assets that you own, like your home. And I think that would be terrible injustice to get into a car accident with somebody and they can actually sue you and take your house away from you. So we always want to make sure that our limits are set at an appropriate level when we get our auto insurance and not just at the cheapest level so that we can get the insurance for cheaper. The last and not least is life insurance. Now there's a multitude of companies that sell life insurance, but when you talk about life insurance, you're really only talking about two types, and there's term and whole life. And I'm not going to get into another long session about the difference between the two, but just know that about 95% of all Americans should have term life insurance according to every investment professional out there, right? They'll tell you that term is the best product for your money. And the reason why is that life insurance was actually not intended to be forever. Okay? There's this term of theory of decreasing responsibility. And basically that says that in your early years, you need a lot of life insurance coverage. And it's not because we don't work hard for our money. It's just that we don't have a lot of it yet, right? Our children are young, our debt is high, and we have a house mortgage typically. So any loss of income in those early years when we're trying to build that nest egg would be devastating to that family if mom and dad didn't come home. But as we get older, now that nest egg that we started accumulating, it starts to grow. And then our need for insurance goes way, way down. So that way in the later years, well, now our children are grown, our debt is lowered, our mortgage is paid off. So at that point in time, we need retirement income and not so much life insurance. And that's what term life insurance gives you. It gives you the most amount of coverage for the least amount of money for the time frame that you need it the most, which is in these years when you're building that nest egg. So now back to our house. So now we're going to build the walls to our house. And in the walls of our house, we're going to put our debt and our income. The reason why we link these two things together is because income and debt is basically a revolving door. Every time money comes in, it goes right back out to pay debt, and then we create more debt that comes and just eats up our income. So every month, right, our bank account is basically a revolving door. Money comes in from work, and then it goes out to pay off a bunch of debt. So eventually we want to get to the point where we eliminate our debt. And then that way we just have straight income. Well, how are we going to eliminate our debt? Well, we teach debt snowballing. And what debt snowballing is you're going to pay off your debt, but you're going to pay it off in a way where you're going to take your lowest balance, whether that be on a credit card or a department store card or whatever you owe money on. You're going to take that lowest balance and you're going to pay extra on that as much as you possibly can. If it's $5-10 a month, then it'll be $5 or $10 a month. If you can afford to pay $40 or $50 more on it, then you pay that $40 or $50 more. So let's say if we had 3 different cards and one was a $50 payment, one was a $100 payment, and one was a $150 payment. Well, what we're going to do is we're going to pay extra on our $50 a month payment until it's paid off. So once that $50 a month payment is paid off, then we're going to take that $50 that we were paying there and we're going to roll it over to this $100 debt. So now we're going to pay $150 on this debt until it's paid off. Then once this $150 is paid off, once this debt is paid off, then we're going to take that $150 and we're going to roll it over here to this $150 debt, and we're going to pay $300 a month on that until that's paid off. So this is the basic theory behind debt snowballing. Is once you get one paid off, you just keep snowballing it until all of this debt is paid off. Okay? Now, this is step 1 down here. This is step 2. Now, somewhere in between step 1 and step 2, or while you're doing step 1, you're going to create an emergency fund. And that emergency fund is going to have $1,000 in it. And the reason why we want to have $1,000 in our emergency fund is that anything that comes up along the way, right, that we deem to be an emergency, then we're going to use that money to pay for it. So a tire blows out on your car, costs $250 to replace a tire. If we don't have that in cash to pay, then we take it out of the emergency fund. A lot of times where people get themselves in trouble is that they don't have this money readily available. So therefore, every time something happens, it becomes an emergency, right? Well, we don't want everything to be an emergency. We want to start planning for life's little emergencies because we know things are going to happen and things are going to come up. So why not have some money sitting on the side so when those things come up, right, we don't have to go and borrow money from somebody, or we have to go to title loan places or pawn shops and do those kinds of things, because we've got our emergency fund here and just in case. So now we've completed step 2. We've got all of our debts paid off, and now we have an extra $300, right, that we were paying on these debts, but now we have $300 to spend on whatever because we're debt free now. Well, what are we going to do with that $300? Well, then we're going to implement step 3, which is we're going to put a roof on our house. And in that roof, we're going to put our savings and retirement. So now, without spending any additional money, right, we're going to take this $300 that we were spending on debt, and we're going to invest that money into our retirement. Now, when we're going to invest this money into our retirement, how are we going to figure out what our investment is going to do? Because this is what confuses a lot of people. Because they get this money and then they're like, okay, I'm going to put it away, but where do I put it? Well, we're going to invest that money in a mutual fund. Now, mutual funds have been doing between 12 and 15% for almost the last decade. Okay, why is that important? Why is that interest rate so important? Well, let's look at it. There's something called the Rule of 72. And the Rule of 72 tells us that if we take the interest rate that we're getting on our money and we divide it into a constant of 72, it's going to give us the number of years it takes that money to double. Okay, so if we got 3% and we got $10,000 in an account that's getting us 3%, 3 goes into 72, 24 times. So every 24 years, this money doubles. And in 48 years, it goes from 10,000 to 40,000. That's not too bad. We can agree that 40,000 is more than 10,000, but it took us 48 years to get there. Well, if we double the interest rate to 6%, well, 6 goes into 72 12 times. So now every 12 years that money doubles, it goes from 10 to 20 to 40 to 80 to $160,000. So even though we doubled the interest rate, we actually quadrupled the money. Well, we look over here at the last column. What happens if we get 12%? Well, 12 goes into 72 6 times. Every 6 years, this money is going to double. It's going to go from 10,000 to 20 to 40 to 80 to 160, 320, 640, 1.2, and $2.5 million. Same 48-year period, same initial investment of $10,000, but the vehicle that that money was in, right, was getting 12%. So this is much, much better than 3%. And if you look at banks right now and you look and see what a savings account is going to give you, right, it's typically going to give you about 1.5%. You might get some CDs and other things that are getting about 2.5%. So this is, on a good day, you'd get 3%. Right? So we got to make sure we're putting our money in the right vehicle, because if I'm driving a Ferrari, and I don't even have to be the best driver in the world, but if I'm driving a Ferrari and you are the best driver in the world, but you're driving a Honda, right? I'm going to get to my destination a whole lot faster than you are. So we want to make sure we get to our destination of retirement as fast as we possibly can. So we want to get that money working for us as fast as we possibly can. So now we got our $300 that's going into a retirement account every month. And we just seen from the rule of 72 that this money, as we put that in there every year, is going to grow and grow and grow and grow. And then when we get to our retirement age, we'll have somewhere in the vicinity of $1.5 to $2 million in that retirement account. So this is where we start to build wealth at, guys. So this is going to protect us if we live too long. We'll have $1.5 to $2 million in a retirement account. And unfortunately, if we don't make it to retirement and we die too soon, well, now we have our life insurance that's going to pay out a death benefit to our family. So we're going to be protected on both sides from the unknown if we die too soon, or if we made it all the way to the retirement. Now we're going to retire with money in our account. So that's pretty much it. I hope this video helps you guys out, gets you on a basic understanding of how you're going to build your financial house. Now all you got to do is go out there and apply these general rules and start getting your plan in place to retire. If you have any questions, email me in the link below. Comment on this video. If there's something else you want to see or you want to talk about, definitely comment below, and I'll work on getting that video posted up to you as soon as I possibly can. Thank you guys. Have a blessed day. Bye.